Good day, everyone, and welcome to the Bell Equipment results presentation for the year ended 31 December 2024. I'm Ashley Bell, Group CEO, and I'm joined today by Karen van Haagt, Group CFO. I'm going to run you through an operational update, and then I'll hand over to Karen to take you through the numbers before I wrap up with a forward view on our strategic priorities for the group. Each year, we like to provide a recap of our current business model, which consists of two distinct business streams. We have our global OEM business, which designs and builds equipment for mining and construction, as well as forestry and agriculture machines. The OEM sells its products to dealers and supports these dealers in the aftermarket. Then we have our owned dealer operations in South Africa, Zambia, and the United Kingdom. These operations sell both Bell OEM products as well as complementary partner products in certain regions to end customers. Our dealerships also provide product support to end customers in the aftermarket. We have a third stream in the making, which is our newly established contract manufacturing division in Richards Bay, offering manufacturing services to the Bell OEM and other external customers using locally sourced materials. Global reach. Over our 70 years in business, we have grown our global footprint through the development of world-class products sold and supported through an extensive network of dealers. Our OEM range of equipment currently consists of some 47 product models for mining and construction, as well as forestry and agriculture. Aside from our three owned dealer networks, we have 114 independent dealers selling and supporting product in over 80 countries around the world. Our products, as you know, are produced out of two factories, namely Richards Bay, South Africa, and Kindle, Germany. Summary for the year. It's important to emphasize that during the post-COVID years up until 2023, our industry experienced an unprecedented boom in demand for the equipment that we produce and sell. At some point, the cycle had to turn, and whilst we expected 2024 to be a year of normalizing, the reduction in demand turned out to be more severe, coupled with supply chains catching up, resulting in an influx of finished goods inventory across the industry globally. Our focus during 2024 turned to cost containment, cash preservation, operational efficiencies and quality improvements, and regaining market share lost during the prior years of constrained supply. Whilst we had to navigate prevalent political uncertainty globally, a more stable supply chain ensured that we were able to meet our production plans and the delivery expectations of our dealers and customers. This is an aerial view of our Richards Bay factory in South Africa. This is the heartbeat of our South African OEM business. OEM operations in South Africa. External dealer sales from our OEM operations in South Africa increased very slightly and now represents just over 22% of group sales. A cooling commodity cycle resulted in lower demand for our products and the necessity to reduce production volumes through the factory. We made a start in the procurement of non-Bell OEM manufacturing work at our Richards Bay factory, and the growth of this division remains a strategic focus going forward. Our new motor grader will be produced by our Richards Bay factory, with the start of production and deliveries of this product to Southern Hemisphere markets from mid-2025. We expect commodities to remain under pressure, but finished goods inventory levels across our industry to normalize during the year ahead. OEM operations in Europe. This is an aerial view of our European ADT factory located in Kindle, Germany. In addition to our factory in Kindle, we also have our European Logistics Center located in Elsfeld, Germany. This is an aerial view of that facility. OEM operations, Europe. With Northern Hemisphere markets under significant pressure, our sales to external dealers from our European OEM operation reduced to 33.1% of group sales, compared with just under 42% in the prior year. Whilst the USA market remained more resilient than anticipated, we came up against stiff competition on the back of very high finished goods inventory levels across the industry. Product to the USA is produced in our factory in Germany. The lower production volumes through our factory in Germany contributed to a reduction in operating inventory and gearing. We expect Northern Hemisphere markets to remain challenging, but we continue to focus our efforts on growing ADT market share, particularly in North America. Our most critical strategic initiative to enhance our ADT manufacturing capabilities in Europe, which is a 3 to 4 year project, is ongoing, while at the same time, we are monitoring the threat of potential tariffs imposed on the region. We're concerned with the growing geopolitical uncertainty and the risk of a potential trade war across global markets. Onto our direct sales for South Africa. This is an aerial view of our BESA head office in Jet Park, Johannesburg, which is located on the same property as our Global Logistics Center, which is the large warehouse in the foreground of the picture. Direct sales, South Africa. Sales from our BESA dealership during 2024 made up 38.2% of group sales. Operating profit increased to 247.8 million. There was a concerted effort to regain market share lost during the prior years of constrained supply, with some success. We saw improved product availability across our OEM and partner product lines, which assisted in this regard. The construction sector remained volatile, and the mining sector came under some pressure through the year. A common thread across all markets globally, as pointed out already, is a high level of finished goods inventory, making for highly competitive trading conditions. We are cautiously optimistic that certain mining sectors will continue to support demand and that we see some traction in the long-awaited infrastructure spend in South Africa. A key objective for BESA in 2025 is the successful launch of our new motor grader. We have keen interest from our customer base, and we will have all hands on deck to ensure that we meet customer expectations with the rollout of this product. Direct sales, rest of Africa. During 2024, we took a decision to close our dealership business in Zimbabwe due to an extremely challenging and unsustainable operating environment. At the same time, we appointed an independent partner to represent us in this market going forward. Our dealership in Zambia performed well, contributing 6.6% to group sales. This market is driven by commodities, most notably copper. We are encouraged by the expansion of mining activities in Zambia, which we believe will support demand for our equipment going forward. However, we are cognizant of possible uncertainty leading up to the general elections in Zambia in 2026, and we will monitor the situation closely as the time approaches. Sustainability and strategic positioning. We continue to invest in the development of new products, which are complementary to our current product offering and distribution network. We're focused on growing our market share with existing products. Growth in our Bell Heavy Industries division in Richards Bay is a priority for us. The growth of BHI goes hand in hand with our strategy to enhance our Northern Hemisphere ADT manufacturing capabilities. This is to manufacture closer to our larger ADT markets and supplier base, to shorten our working capital cycle and lower our investment in inventory, and improve our ability to respond to changes in the market more swiftly. The project involves resourcing certain components and introducing new suppliers, all of which involves extensive testing to ensure the continued high standards of durability and quality in our product. Growth and investment strategy. Touching on some of the product developments that we've been working on. The motor grader has been a significant investment for us over the last 5 to 6 years. During 2024, we manufactured 9 pre-production machines to iron out our manufacturing processes and supply chain. We had originally anticipated startup production from Q1 of 2025, but this moved out a few months due to the timing of the completion of pre-production machines and supply chain readiness. Start of production is now mid-2025. We have had very positive feedback from markets and believe that we have a top-tier product from a design, durability, and performance perspective. On our current core product, the ADT, we have ongoing product enhancements that we're investing in, such as autonomous control, particularly for Northern Hemisphere markets. We offer an autonomous-ready ADT to the market and have driverless machines running in Europe and North America. We are industry-leading in terms of control system integration and work with multiple technology partners. In pursuit of a zero-carbon future, we continue to explore alternative fuels and propulsion technologies, which will be incorporated to our next-generation ADT upgrade. On the forestry and agriculture side, we're excited by our new timber processing head, which is used in timber harvesting operations, and our prototype unit continues to perform well. We will be building pre-production units during 2025. We also have a prototype skidder for timber extraction and testing and look forward to gathering further performance data on this machine. Our haulage tractor has been an offering in our agricultural range for decades, and we're in the final stages of launching a new higher powered version for heavy hauling applications. I'm now going to hand over to Karen to run you through the financial slides of the presentation.
Hello, everyone. I'm Karen van Hucht, and I'm the Bell Group CFO. I'm going to take you through the 2024 year-end results. Revenue and operating profit. Revenue decreased by 13% in 2024 to 11.7 billion rand from 13.5 billion rand in 2023. We had anticipated the change in market conditions and had started to prepare for the slowdown from the first quarter of 2024 by planning for lower sales and by reducing production volumes. Revenue for the first half of 2024 was comparable with 2023 levels, but by the second half of the year, the extent of the slowdown was evident, and revenue for the second half of the year was 17% lower than in the first half. Profit from operating activities for 2024 of 754 million rand was a reduction of 37% on 2023. In line with the reduced production and sales volumes in the second half of the year, profit from operating activities in the second half was also substantially lower than in the first half. This highlights how volume dependent the group's results are. Lower production volumes means low recovery of fixed costs at the group's factories in both Richards Bay and Eisenach-Kindl in Germany, and this has a negative impact on the bottom line. Earnings and headline earnings per share. EPS and HEPS were both down by 42% on 2023. The diluted EPS and HEPS disclosed in the annual financial statements reflect the impact of the potential shares relating to the BEE transaction undertaken in 2019 and the options held by those BEE parties. The estimated dilutive impact on those options is driven by the valuations of the specific group entities in which the BEE parties hold interests and by the share price at year-end. Foreign currency gains and losses. The group has always had a strong natural rand hedge because foreign currency proceeds from export sales, which are mainly in US dollars, are utilized to settle import commitments, which are in euros, US dollars, British pounds, and Japanese yen. However, as a result of differences in the timing of cash flows, different payment terms on customer and supplier accounts, and the impact of the manner in which the accounting standards require transactions to be accounted for, substantial foreign currency gains and losses are reflected in the financial results. This relates to foreign currency gains and losses on cash flows during the year and also on the revaluation of monetary balances at year-end. In 2024, although the gross forex gains and losses are large, the rand was less volatile than in some previous years, and net foreign currency losses totaled just 200,000 rand for the year. Balance sheet, December 2024 compared with December 2023. Total assets decreased by 14% in 2024 to 9.1 billion rand. Most of this decrease was in current assets, with the largest reduction in value being in inventory and in receivables. Inventory decreased by 11% or 650 million rand in 2024. A more detailed breakdown of the inventory is provided later on in the presentation. Trade and other receivables decreased by 33% in 2024. Apart from a reduction in the value of receivables relating to the reduced level of sales in 2024, the receivables at the prior year end were exceptionally high due to a late catch-up of production towards the end of 2023, which resulted in a large volume of machines being invoiced and shipped to North America just before the year end. This was not repeated to the same extent at the end of 2024. There were no significant new additions to property, plant and equipment, nor to right-of-use assets in 2024. Equity and liability side of the balance sheet. The main change relates to the reduction in debt and trade payables in 2024. This is due to weaker market conditions and the lower planned production levels, and also the collection of the high receivables balances that were outstanding at the end of 2023. Lower production volumes meant a lower level of purchases of components and raw materials for production, and the lower working capital requirements drive the lower borrowings and trade payables at year-end. Income statement. As already mentioned, revenue of 11.7 billion rand was down 13% on 2023. The GP percent was 21% compared with 20% for 2023. Considering the cooling off of markets and the very price competitive environment, we are satisfied with that result. Other operating income reduced by 8%, mainly due to lower incentives earned on the production-based automotive production development program due to lower production volumes in 2024. Expenses increased by 10% compared with 2023, driven up mainly by the lower capitalization of labor costs and overheads to inventory due to the lower production volumes in 2024. The majority of the cost base of the factory operations is fixed, and as mentioned, higher throughput at the factories has a positive impact on the bottom line. The lower borrowings meant that interest charges were at a lower level than in the prior year. Notes on inventory. Inventory reduced by 11% to 5.1 billion rand at the end of 2024, compared with 5.7 billion rand at the end of 2023. Manufactured machine inventory was up by 58% to 1.2 billion at the end of 2024, and this was higher than planned. We have seen this reduce in 2025 as machines have been invoiced and shipped to customers, primarily in North America. The lower level of components and raw materials at the factories reflects the lower production levels going into 2025 than at the start of 2024. Going into 2024, there were also substantial component and material buffers in place to try and manage the supply chain and the port challenges at the time, and many of those buffers have now been reduced. Cash flow statement. On a positive note, net cash inflow was 458 million rand for the year. The cash generated from the reduction in working capital was the most significant contributor to the cash inflow. Bank debt, including the trade loan and supply chain finance balances, which are reflected as interest-bearing liabilities and financing activities on the cash flow, also reduced in 2024. As mentioned earlier, interest payments reduced due to the lower average borrowings in 2024, relating to the lower level of working capital funding. Tax payments also reduced in 2024 due to the lower profitability of many of the operations. Net debt and finance costs. Net debt and gearing levels were significantly lower at the end of 2024 compared with 2023. Interest cover reduced due to lower earnings, but net debt to EBITDA improved due to lower net debt levels in 2024. The group targets a net debt to equity ratio of no more than the 30% to 40% range, and we ended the year well below that, with gearing of 9.5%. This is directly related to the business cycle and the current levels of worldwide demand for the equipment that the group manufactures. Segmental revenue. The most notable reduction in revenue in 2024 was in the manufacturing operation in Europe due to the softening of the North American, EU, and UK markets during 2024. The revenue reduction in the rest of Africa segment is due to the closure of the group's operation in Zimbabwe. The group will be represented by an independent dealer in that market in future, and the sales will be reflected in the South Africa manufacturing segment as machines will be sold to the independent dealer directly from the Richards Bay factory going forward. Segmental operating profit. The most notable decrease in profitability in 2024 was in the OEM operation in South Africa, which is within the SA manufacturing segment. This is mainly due to lower production and sales volumes of complete machines and kits at the Richards Bay and Eisenach Kindle facilities, and the lower level of recovery of labor costs and overheads compared with the prior year. By contrast, in 2023, when very strong market conditions and volumes were experienced, this OEM operation reflected the greatest increase in profitability. The rest of Africa segment reflects a reduction in operating profit, the consequence of a trading loss and once-off costs relating to the closure of the Zimbabwean operation, a provision for the possible non-recovery of long outstanding refunds from the tax authorities in Zambia, and a review of the factory pricing of manufactured product for that market. Thank you, Ash.
Thanks very much, Karen. Looking ahead, we remain cautious in our outlook given the rising geopolitical tensions and the impact this might have on markets globally. The USA remains a strategic focus for our business, as this is the largest ADT market in the world. The risk of potential import tariffs in this market is key. We continue to drive new product developments and enhancements to existing product lines. The successful launch of our new motor grader to Southern Hemisphere markets in 2025 is an absolute priority for our group. Through our own dealerships, we are vigorously pursuing the growth and sales of our complementary partner product lines. Growing our lifetime revenue stream contribution to our revenue is critical to improving the performance of our business. A strategic initiative to enhance our ADT manufacturing capabilities in the Northern Hemisphere and to grow our contract manufacturing business, BHI, in South Africa is key to our business sustainability going forward. And lastly, we need to ensure that the hearts and minds of our people are aligned with the strategic objectives of our company, and we are ensuring this through our internal organizational development initiative that we call the Building a Stronger program. Moving on to the final slide. In closing, we just want to thank you for taking the time to listen to our presentation. We appreciate the support that we receive from all of our stakeholders. If you have any questions, please feel free to reach out via the contact details shared in this presentation. Thank you.